This is the Friday, August 14th, 2015 version of the Market Plus segment. Joining us now is Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Mike.
We did not get a chance to talk about really the one bullish story that came out of the USDA report this week, and that was the cotton market. Saw a $4 move to the upside after 6 weeks of downward moves. Where is this thing going?
Talk about a dull, boring story. That cotton has done nothing for a long time.
Yeah.
But they reduced acreage. They've had all kinds of production problems down south. They really cut the yield. And as a result, we had a nice $4 rally. Now, I think I think there's a little more in it. I think you could at least go up to 68. If we hadn't had this currency problem and with the China, I mean, a lot of that cotton goes to China. With that reduction in the currency, if that hadn't happened, I would think we'd have a good shot at 175 or at 75 on cotton. But with that going on, you know, maybe 68 to 70 now is your upside. So if I own some cotton, I'd be a little patient on
Hold it and just see where it goes.
Yeah, for a while
you don't
here.
at this point have much to lose after we took what, $6, $8 off that market for the past 6 weeks.
Right.
Now we're letting put a little bit back on.
Yeah, that's what I'd be patient there, because there may be some more here, and see if this Chinese currency stabilizes. Yeah, maybe there might be some go in cotton.
Okay. Now you mentioned the Chinese currency. That was the big. That was before the report. That was Tuesday night. China announced they were going to devalue the Chinese yuan about 1.9%, if I'm remembering correctly. So we've got a question here, again from Will in Jasper County, and he's curious, that Chinese deflationary move and the surprise USDA report, those were the big stories this week. Which, in your opinion, will be a bigger influence on the market in the next 9 months?
U.S. crop.
Okay.
I don't think there's any doubt about it. I mean, a lot of our demand's being lost to South America, and that's partially because of the real dropping, not so much the Chinese currency. So in my mind, the fact that we've got a big crop is our problem, that we cannot compete against South America to sell. So that to me is way more important than the drop in the Chinese currency for our bean market here in the U.S.
Well, now, as we look at the bean market, so we took 50 cents off U.S. beans this week, 62 cents alone on Wednesday. Even with the strong dollar, the thought would be that should make us more competitive on the international stage. Does it?
No, it doesn't at all. As our market dropped this week, we also saw the South American. I mean, we gained no advantage basis-wise. They still are undercutting us price-wise. So the business is still going to continue to go to South America. And that's going to be a problem for this bean market. It could be, the USDA's export sales numbers could be substantially off. I guess I wouldn't be surprised to see a carryout creeping up in that 550 to 570 range. So that's going to be a problem. Domestic demand's good. USDA bumped the crush up again. We've got a NOPA crush number coming out Monday, which will probably be supportive. Maybe not as good as June, but
June was nearly record.
Was really good, yeah.
Yeah.
But probably 20 to 22 million better than it was a year ago. So I mean, we got good, strong domestic demand for meal, which is what's driving that.
Okay. And even with an $18 sell-off this week in the meal market, probably still coming on the heels of that 50-cent bean, there's still some gravy in there for crushers.
I think they're going to continue to crush like crazy, which is going to help support that domestic market. For those guys that haven't sold beans, it should keep their bases pretty good here, at least until new crops available. And
probably especially in the Eastern Belt, where those exceptional bases have been for the last month and a half.
Yeah, the only thing that's going to temper that is maybe the talk of some Brazilian meal coming into the southeastern United States. But other than that, yeah, it should be well supported.
Okay.
Basis-wise, anyway.
Now, you talked on the program about this year's corn yield, and you weren't terribly surprised by USDA's number. So Ron in East Central Illinois is curious, can the U.S. corn yield this year actually be higher than in 04 and 09?
Yeah, I think there's a very good chance it will. But you know, the thing we tend to forget here is that we're putting a lot of technology out in the field, and it's continued to improve. And it's not just better seed. It's everybody and their brother's got a high clearance sprayer. So when you get a little depletion in nitrogen, they run out there and stick a little extra nitrogen on. When we had good corn prices, everybody went out and spent a ton of money on tile. So you got better drainage. And I mean, it's all those little things that add up to better corn yields. And I think the USDA number we saw this week sort of reflects some of that.
Now, one of the things that we touched on the program just barely, so as we watch this corn crop grow in the field, at least versus what producers had been expecting, the hope is that we'd be able to pick up some international demand. Now, you've mentioned how affordable those South American beans have been. South American corn, still a discount buy to U.S. corn?
The Brazilians produced 4 million metric ton more corn than they did last year. That's a substantial increase, a record corn crop. All of that, almost all of it came in their second safrinha crop, which is the one they export. They're exporting corn into the October, November, December time period when that used to be totally the U.S.'s market, and it's not. That they're selling corn into that period with talk of them even starting to move a little corn into the January time period. So that's a problem. Their corn is 22 to 32 cents under what the U.S. price is at the Gulf. So we're going to have to get competitive if we want to start getting back some of that export market that the USDA says we're going to have.
Now, looking into your crystal ball, given that South American beans are under ours, given that South American corn is 25 to a couple cents more than that under ours, looking out next year, 2 years from now, can South American producers continue to afford to grow record crops, buy the inputs, buy the seed that gives them those crops over the next couple of years, or are we beginning to price them out of the market?
Heck, yes, they can. The drop in the real, they're still getting $12, $13 for beans relative to what we're getting. They're as happy as clams down there. Okay. So, heck, yes, the expectations are they're going to be up another 4 or 5% in production next year. Plus, supposedly we're going to have this super El Nino that could carry all the way into next spring, which means they're probably going to have another good crop. The only bad thing about that El Nino is it could hurt the Australian wheat crop, and that could be a bit of a supportive factor in wheat. But it certainly is not going to be a benefit to the U.S. farmers in terms of reductions in South American corn and beans.
Okay, Tom. Well, this has been kind of a downer discussion for a lot of our producer viewers out there. Let's talk something that might be a little more positive, farm diesel. We've seen crude oil sell off this week. Looks like we pushed through some of those spring lows. Where is this crude oil market going to go?
I think crude oil's headed down. U.S. production still running substantially over the 5-year average. OPEC hasn't cut back at all. Maybe the tar sands a little bit, but even with the rig count down substantially from last October, a year ago, production's hardly fallen off at all because the rigs that are producing so well. And then on top of that, the icing on the cake, all that cake, is the Iranian nuclear deal, which is going to free up Iran. And they've already started to gear up, and they're going to have substantial exports, which they really want to move to get the cash. So, and then on top of that, you got the cherry, and then we've got a little icing. We've got all these boats floating around filled with crude oil that they filled up, sold to carry, collecting the carry. So it's going to take quite a while to sort of work through all that inventory once we do start to contract production a little bit. And I don't know who's going to be the first to blink on that.
So we could see another $5, $6, $7 move downward in the crude market?
I think you could go down to 35, yeah.
Okay, all right. So maybe we can lock in some farm diesel a little bit cheaper.
Well, you want to wait on that because you got, in the summertime, all the refineries make gas and they back off on the distillates. Now they're going to start gearing up for winter heating oil, and that's going to start to drive that price down. So we've already pulled back somewhat on diesel, but there might be a little more.
Maybe let it run.
Yeah.
All right. Well, Tom, thanks so much for joining us this week.
Thanks, Mike.
Thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so, and we will get expert analysis right to you. Thanks for watching, and have a great week.